Hi everyone. Let's start with a simple question. What happens in your personal life if you consistently spend more money than you earn? You dip into your savings, right? Or you put it on a credit card, going into debt. You might sell your bike or your car to cover the gap. Well, countries do the exact same thing, just on a colossal scale. This national checkbook is called the balance of payments, a systemic record of all economic transactions between a country and the rest of the world. And when a country runs a deficit, particularly in its current account, which covers trade in goods and services, as well as primary income like dividends, it means it's a net borrower from the rest of the world. Essentially, it's consuming more than it produces, and the rest of the world is funding the difference. But here's a crucial part we're exploring today. This situation can't last forever. Powerful automatic economic forces are triggered to correct this imbalance. Trying to resist these forces is like trying to hold a beach ball underwater. Eventually, the pressure builds up and erupts at the surface. Today, we're going to move beyond just the definition and dive deep into the casual reasoning behind three core automatic adjustment mechanisms: the price channel, the income channel, and the automatic monetary channel. Let's get started. Our first mechanism takes us back to the era of the gold standard, a system of fixed exchange rates with currency that was backed directly by gold. Imagine country A has a current account deficit. It's importing more gadgets and coffee than it's exporting its own cars and software, so it needs to pay for the difference. Gold is the ultimate money, so gold physically flows out of country A to its trading partners. Now, let's ground this in economic theory, the price-specie flow mechanism. Famously articulated by the philosopher David Hume in the 18th century, this gold outflow isn't neutral. It directly reduces country A's monetary base, the very foundation of its money supply. A modern, real-world shadow of the price-specie flow mechanism played out during the Eurozone crisis, and it perfectly illustrates the mechanism's logic. While not a gold standard, the Eurozone functions as a fixed currency block for its member countries. Imagine Germany, with a huge current account surplus, was effectively accumulating financial claims, modern gold, from deficit countries like Greece and Spain. The European Central Bank's rules created automatic pressure for austerity and deflation in the deficit nations to restore competitiveness, since they couldn't devalue their own currency. This led to a painful period of high unemployment and social strain, demonstrating that even in a modern system, the classical adjustment pressures are still powerfully at work when the price channel is the only available option. According to the classical quantity theory of money, a reduction in the money supply, assuming stable velocity and output, leads to a fall in the general price level, or deflation. Now, think about the impact on trade. Goods from country A have become cheaper for foreigners, so its car exports become more competitive and rise. Meanwhile, foreign goods have become relatively more expensive for citizens of country A, so its imports of those gadgets and coffee fall. This change in relative prices, driven by the automatic change in the money supply, works to correct the initial current account deficit. It's a beautifully simple, self-correcting system. However, its effectiveness relies on two big assumptions: that prices and wages are perfectly flexible downwards, and that the economy is operating at full employment, which brings us to our next channel. In the modern world, prices, especially wages, are often sticky. They don't fall easily, so when prices don't adjust, we need to look at another powerful variable: national income. This is the Keynesian perspective, which focuses on aggregate demand. The key insight here is that a current account deficit isn't just a trade number, it's a leakage from our domestic circular flow of income. So let's trace the steps. Step 1, we start with a current account deficit. Step 2, this means we're spending more on imports than we are earning from exports. This spending is income for other countries, not ours. It's a leakage, much like savings. Step 3, this leakage reduces our aggregate demand for domestically produced goods and services. Step 4, lower aggregate demand leads to a contraction in our national income, or GDP. We see slower growth or even a recession in extreme cases. Here's the critical causal link for adjustment. As national income falls, people have less disposable money to spend. And what do they cut back on? Everything. But importantly, they cut back on important goods like luxurious imported food, overseas vacations, or an expensive foreign car first. This is known as the marginal propensity to import. When imports fall due to this income effect, the current account deficit shrinks automatically. This is an adjustment driven not by changing prices, but by the painful reality of changes in the level of economic activity itself. It's the economy self-correcting through a slowdown. The United Kingdom, after the 2016 Brexit referendum, provides a stark case study of the income channel in action, but with an interesting twist. The vote caused the British pound to plummet, which should have made exports cheaper. However, the uncertainty also hit business investments and consumer confidence, leading to a slowdown in national income. As the income channel predicts, UK imports fell significantly because households had less real spending power. But here's the twist. The uncertainty also hampered export growth, despite the weaker currency. This shows that these channels don't operate in a vacuum. The income effect can sometimes dominate the price effect in the short run, especially when confidence is
So we have our models, but what about the real-time, high-stakes world of foreign exchange markets? This is where the most immediate and powerful adjustments often occur today. To understand it, let's look at a country that tried to defy gravity and failed amazingly. Switzerland in 2015. For years, the Swiss National Bank had enforced a fixed exchange rate, pegging the Swiss franc to the euro. They did this because the franc was considered a safe haven currency in times of global trouble. Everyone wanted to buy it, driving up its value and crippling Swiss exports. The SNB had to constantly create francs to sell them to buy euros, amassing up huge reserves. This was a fight against an automatic appreciation pressure. But in January 2015, the cost of this intervention became too high, and they abruptly gave up. The result? The franc soared 20% in minutes. This event is a perfect prelude to our next channel, showing a sheer market force that the automatic monetary channel is.
Now, let's look at the most modern and direct mechanism, which explicitly ties the balance of payments to monetary policy and exchange rates. This is the automatic monetary channel. Let's break this down. A current account deficit means the value of our imports exceed our exports. To pay for those extra imports, people in our country need to sell our domestic currency, say dollars, to buy foreign currency like euros. This action represents an increase in the supply of dollars on the foreign exchange market. Now the adjustment path depends crucially on the exchange rate regime, and this is where the story splits.
First, under a floating exchange rate, with this new increased supply, there is now an excess supply of dollars at the original exchange rate. The market corrects this instantly through a price change. The value of the dollar depreciates. Think of the yen or the British pound falling in value. A weaker currency makes our exports cheaper for foreigners and our imports more expensive for us, which directly improves the current account. Second, under the fixed exchange rate, the government has committed to maintaining a fixed rate. With the excess supply of currency, the central bank must intervene. It buys up its own currency and sells its foreign reserves to absorb the excess supply and defend the fixed rate. This action is not discretionary policy. It's an automatic consequence of the regime. And critically, when the central bank buys its own currency, it is taking that money out of circulation, directly contracting the domestic money supply.
This leads to a monetary squeeze. A smaller money supply leads to higher interest rates. These higher rates attract foreign capital, improving the financial account, which helps finance the deficit. But they also cool down the domestic economy by making borrowing more expensive for businesses and consumers, which reduces demand for all goods, including imports. So, even under a fixed rate, the system automatically creates pressure to correct the deficit, this time through a combination of reserve losses and tighter monetary conditions.
But there's a crucial modern twist we must consider: capital flows. In today's globalized world, the current account is only one part of the story. The financial account, which records cross-border investments, is often the dominant force. A country like the United States can run a persistent current account deficit because it has matching financial account surplus. Foreign investors are eager to buy U.S. assets like treasury bonds and tech stocks. They are effectively lending the U.S. the money to cover its trade deficit. In this case, the automatic adjustment mechanisms can be suspended or muted for a long time. As the desire to invest in the country outweighs the trade imbalance, the deficit is a sign of strength and attractiveness. However, this relies on sustained global confidence. If that confidence wanes, the automatic monetary channel can trigger with a vengeance, leading to a sudden stop and a severe currency crisis.
So, let's bring it all together. Whether it's through the classical price channel, the Keynesian income channel, or the automatic monetary channel, the balance of payments has powerful built-in stabilizers. The specific path of adjustment depends on the context, the exchange rate system, the flexibility of prices, the mobility of capital, and the state of the economy. But the underlying principle is the same. Barring massive and continuous capital inflows, economies have a natural tendency to move toward external balance. For policymakers, this is a critical lesson. Fighting these automatic adjustments, for example, by printing more money to offset gold outflow, or by depleting foreign reserves indefinitely to defend an overvalued currency, often just prolongs the deficit and leads to a deeper, more painful crisis later. often involving a sharp devaluation, banking crises, and severe recessions. Sometimes understanding economies is about knowing when to let these inherent forces do their work. The next time you read a headline about massive trade deficit, you'll know the story isn't over. The invisible hand of the international financial system is already at work, orchestrating a complex, automatic balancing act through prices, income, and monetary flows. The only question is how quickly and through which channel the correction will arrive. Thanks for watching, and goodbye.